2023 has been a disastrous year for a lot of the media stocks, streaming stocks. You have Paramount down 42%. This is a stock that Warren Buffett actually owns. You have Warner Brothers Discovery. I made a video on it. It's down 28%. We have Disney stock. Walt Disney is down 19%. But it's been a while since I've done an update on Paramount stock, Warren Buffett stock, which is why I decided to do an update in today's video. This is an extremely difficult stock to value. Even WBD is an extremely difficult one, but especially Paramount. There's a lot of things going on, a lot of messed up numbers. So I'm going to do my best in this video to review Paramount, review the value propositions, maybe try to determine why Warren Buffett still owns it, because he still owns, around 15% of the company, 15% of the shares outstanding. He's been selling something like HP, the computers and stuff. He's been selling his stake in HP, but he's still holding Paramount so far. Even though he was not happy with the dividend cut, you could hear it in the annual meeting, he was not happy with whatever was happening with Paramount, but he still owns it. So that's a pretty interesting thing to look at, and why, Warren Buffett is still owning it, and if it has some kind of amazing upside potential over the next 3 to 5 years. Now, if you look at the stock, it's been a disaster. It's sitting at March 2020 lows at $12.90 per share. It's been crazy. If we look at the latest earnings report, it wasn't the best in the world. It's still a lot of declines in TV, and direct to consumer is the only one that's growing. It grew over 40%, but a lot of it has been declining because the ad market has been very, very weak. I even see it on YouTube with my own channels. The revenue is not as good as it was a year or two ago, especially when you had a lot of the crypto ads, and we don't have that much crypto ads anymore, and they used to advertise a lot and stuff. So yes, the advertisement market has been weak. Paramount was not the only one facing this problem. WBD is also facing this problem. Disney is also facing this problem. It's a very challenging macro environment for a lot of different, advertisement stuff, maybe cars, maybe homes, maybe furniture, Wayfair, and all. But we don't see that stuff as much as we used to. So the ad market has been weak, and this is one of the reasons why, the TV media, the legacy media, has been in decline in terms of revenues. But, in terms of the best one, which is actually, the Paramount Plus stuff, which a lot of people are excited about. I'm personally not excited about it because it's losing a lot of money. The losses have improved, and the stock went up like 7% on the news. The loss was $4.45, and now it's $4.24. This is a slight improvement, but it's still losing a lot of money. Disney is getting on track to profitability. WBD might be profitable this year, but Paramount has invested, pretty much has gone all in on streaming, and they focus more on revenue growth instead of profitability. But this is hopefully changing, and a lot of the analysts are expecting, the free cash flow to start getting positive in 2024. If you look at the free cash flow trend, it has been an absolute disaster. Now, there was a massive improvement in Q2 2023. They almost broke even on free cash flow. It's been negative for a while, since pretty much the start of 2022. But there's a lot of things going on. It's been a crazy year, a pretty messed up year for Paramount. The way I look at it is Paramount is some kind of an ugly house that needs painting and needs a lot of fixing. And no one wants to touch the ugly house. It's pretty messed up. But after they fix the house and the house looks better, then a lot of people would want to buy it or would want to own it. This is how I see Warner Brothers Discovery, and this is how I see Paramount. Paramount is pretty messed up. They've gone through a lot of stuff in 2023. They cut 25% of staff, did a lot of restructuring stuff within their own company, like the Showtime, kind of business. They also cut the dividends. The dividend used to be 24 cents. They cut it down to 5 cents, which is a smart decision. I would personally prefer if they just cut it to zero, kind of like WBD. WBD is not paying a dividend. I don't know why, Paramount should be paying even a 5 cents dividend. But this is, this is what, Sherry wants. She likes the dividend. Well, now it's around 5 cents. It's not bad. This is still better than it was at 24 cents. This is going to help their free cash flow tremendously in the future, in my opinion. The company has a lot of targets, ambitious targets for 2024. Like, they have over 20% global ARPU expansion. I don't know how this is going to happen, but they did increase prices. They're going to cut back on some costs and, do a few more things and expand a little bit more. It's a pretty competitive price at $12. This is after the price increase. You have Disney at 11, something like Max, which is the WBD service, is between $16 up to $20. Netflix between $15 up to $20. You have also Paramount, which owns Pluto TV. This is a free version. I love Pluto TV. I think it's an amazing business model. It's gaining a lot of traction. A lot of people love this service. I believe WBD is also trying to start something like Pluto TV. But I really like Pluto TV within Paramount. I think it was something pretty smart that the management did before, and they do have again a lot of stuff for 2023. They have a significant margin expansion. I don't know if the streaming is gonna be profitable in 2024, but they said they're gonna have massive earnings growth in 2024, and they said that free cash flow is gonna turn positive in 2024, and the analysts seem to agree with them. The analysts are pricing in that 2023 is pretty much the worst year for Paramount on every single metric in terms of DTC losses, in terms of decline in revenue on the legacy business, in terms of massive, negative free cash flow. They believe that 2023 is the worst year, and they believe that 2024 is going to improve. They're going to make 126 billion of free cash flow. It's going to jump to a massive of 610 million of free cash flow and up to 900 million of free cash flow by 2026. Now, I'm not sure if Paramount can pull this off, but if they could, the stock would pretty much skyrocket. The company used to be a free cash flow machine for years and years and years. They pretty much never had a negative year. Even in 2010, they were positive on free cash flow, except 2023 it was an absolute disaster. So if they could get back to something like 600 million or 900 million and use the free cash flow to pay down the debt, now they have a small dividend, that would be amazing for the company. But I'm not counting on it. I'm going to share my valuation model pretty soon at the end of the video, which I'm not relying on the analysts' free cash flow expectations. But if you look at Paramount itself, it has a lot of legacy assets that they can sell or they can monetize better. Especially CBS, which a lot of people, they don't pay attention to how valuable CBS actually is. They have a contract. They're going to stream the Super Bowl in 2023, 2027, 2031, 78 consecutive years in the NFL. Not a lot of channels actually have, the contract with the NFL to stream the Super Bowl. So this is something pretty valuable for Paramount. They have a lot of valuable franchises. Nickelodeon is one of them for a lot of kids, MTV, BET, Paramount Studios, which makes one of the most popular movies ever, like Top Gun and Mission Impossible and many others. It has a lot of valuable assets that they can sell, and they have an asset that they've been trying to sell for a while, and they finally sold it for $1.6 billion, which I believe was actually a fair price for Paramount. $1.6 billion. They were trying to sell it for a little bit more before, but $1.6 billion for me is pretty good. This would show you what kind of assets Paramount has. They have a lot of valuable real estate in Manhattan and many others. They can sell and do a lot of things with them. So they have a lot of valuable assets and franchises that they can either sell or monetize. And the main reason they're selling a lot of assets is to try to pay down the debt, which is smart. This is what I'm seeing. I'm seeing a dividend cut. I'm seeing a disciplined management that's trying to focus not just on revenue growth, but also on profitability. They finally want to pay down the debt. So I see a lot of improvements. Maybe this is why Warren Buffett is still holding on Paramount, even though the improvements are not showing up on the bottom line yet, but they will eventually show up on the bottom line in the future. This is why no one is touching it right now. But maybe a year or two from now, people are going to love Paramount. But the cash position is $1.7 billion. They have over $15.6 billion of long-term debt. They're selling some assets, doing a few things. I looked at the debt maturities in my previous video. There's nothing crazy maturing before something like 2029 or 2030. So Paramount is fine in terms of debt repayments over the next few years, but the company is trying to rapidly deleverage to pay down the debt. I think this is very, very smart. It's going to be easier with a 5 cents dividend instead of a 24 cents dividend. So everything is going into the right direction. But again, it's some kind of an ugly house that just looks ugly and no one wants to touch it. But it could have massive, massive potential, but it also has massive, massive risk if they could not pull off the turnaround plan. And this is how I think about Paramount. They have around $30 billion of revenues. The expected revenue growth for 2023 is 1%. So I kept it at 1% because the ad market is weak. But I put in for 2024 to 2027 something like a mere 3% revenue growth, which I personally believe is pretty fair. I think most of you can agree with me. I'm not putting in 10 or 15% for Paramount. This will never happen. It's going to be flat to single digit, low single digit, 2 to 3%. So I think 3% is fair. Now, this is the biggest trick with valuing Paramount. This is why it's so hard, because the net income margin is all over the place. Now, if you look at the net income margin, it was extremely profitable, over 13% net income margin before they went all in on streaming and had all that type of stuff happen. Since they've gone all in on streaming and streaming has been losing money, well, the net income margin dropped from 13.6% to 1% in 2023. I mean, 1%, it's unfortunate, but the analysts and the management and pretty much everyone believes that 2023 is the worst year. It's peak losses in streaming, peak decline in a lot of the linear TV stuff, peak in terms of the ad market being weak. So if 2023 is the trough in everything, I mean, the analysts are pricing in a net income margin expansion to up to 6%. I'm not sure if this is going to happen, and I'm not going to bet on 6%. I'm not going to bet on Paramount going back to 8 to 10% if they can just at least break even on the streaming stuff, because the linear stuff is massively profitable, massive free cash flow generating. The CBS and many others of their channels and the legacy business and the movie business, they generate a lot of free cash flow from that stuff. So you could just get back to break even where it was before they did the whole streaming stuff. Maybe they can get back to 11 to 13% net income margin, but I'm not betting on that, and I'm not betting on 6%. What I'm betting on in my valuation model is 4%. Now, this is tricky, because if it's 2 to 3% instead of 4%, the valuation model is going to be entirely different. So I'm just being completely honest. But the way I look at it, the way I look at what Paramount is doing, all the restructuring stuff, paying down the debt, which is going to reduce interest expense, is going to increase net income margins in the future, and everything that's happening, and all the bad stuff and all the bad sentiment, I mean, I can see 3 to 4% net income margin. I'm going to try both. Now, if I use 4% net income margin, I use 12.5 times earnings, which I believe is fair. This is the mean multiple was 12.6 times, 12.5. So I kept it at 12.5. I think it's fair. The dividend is 2%. In total, I see 112% on the upside, or 16.2% CAGR, which is not bad at all. If I want to double on Paramount, I have to buy it, at $13.81 or below, which is higher than the current price. Now, in case the net income margin was 3%, instead of 4%, the upside is only 61%, or 10% CAGR. In this case, I would have to buy Paramount around $10.52 per share. But again, I personally believe it's going to be above 4%. I mean, if the analysts are right, and the net income margin is something like 6%, like the analysts are pricing in for 2026. If it's 6%, then the upside is over 200% or 25% CAGR. I mean, that would look like it much more for me, because if I look at the chart, I see the massive bad sentiment. I see how no one wants to touch Paramount or Warner Bros. Discovery. I think these stocks are going to have massive upside. I just don't know when. But this is my valuation model on Paramount. The worst case scenario is $10.50 per share. The best case scenario is to buy it right now for something like 15% plus CAGR over the next 5 years or even longer. This was not financial advice. It's a hard stock to value. So I hope you appreciated it, and I hope you enjoyed it. So if you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.